Hi everyone, welcome and thank you for joining us for this, the 14th installment of Talking VoIP with Datagate, where we go on a learning journey of subjects related to VoIP, UCaaS, telecom services from the perspective of MSPs and wholesale telecom providers. I'm Mark Loveys, CEO of Datagate Telecom Billing, and in today's episode, the critical role of a telecom tax engine. Our guests are David Rubenstein, Managing Editor, and Deena, Levi, who's the Senior Researcher of Wolters, Kluwer, CCH SureTax, and they are two of the industry's top telecom tax and compliance experts. David and Deena, welcome and thank you for joining us.
Thank you.
Really happy to be here.
So David, how many telecom tax jurisdictions are there in the United States?
There's over 12,000. Our official count is 12,823.
Wow. Excellent. Wow, that's so. I guess address a question now to Deena, who's a senior researcher in this area. Deena, what's involved in keeping CCH SureTax accurately and reliably up to date with all of these 8,000 or 12,000 plus telecom tax jurisdictions?
So we have a whole process. We have a local team that makes many calls every day, every month, and they also send a lot of emails to kind of try to keep track of what's changing, what's current, what's coming up, what's new. We also do a lot of legislative review for any state changes or local changes. It's a constant process. A lot of just keeping track and then inputting it and double checking it and just making sure we're currently up to date.
Right, excellent. And how often do telecom tax rates and rules change? And how much notice do you get of a forthcoming change?
So there are some that change, pretty consistently every quarter or once a year. We know about that. And there's some that just totally surprise us, things that changed during the pandemic that, we didn't know were coming up. And then all of a sudden, wow, here's a big change. And we just have to just keep on top of the news and all the legislative review, going through a lot of articles and papers just to see what's going on.
Right.
There's
Wow.
2 months of the year that are considered our heaviest in terms of content updates. That's the January 1st, of course, the year-end changes, and then July 1st, which we just just had that as well. So there's generally jurisdictions like on a federal and state level will change either on the calendar or on the semi-annual July 1st. Local jurisdictions are not bound by that. Obviously, when you're dealing with thousands of local jurisdictions, that adds, that those are much more difficult to track, and there's not necessarily a expected date where that change will take place. So, but generally, the major changes are going to be either January 1st or July 1.
Right, interesting. And so I guess in the accounting processes, it's important to keep track of what the current rules are, but also the past rules and rates. And so how does CCH SureTax keep track of past and present tax rules and rates?
We have very detailed spreadsheets, and we do keep track of all the changes that have occurred.
Wow.
And the system, that's the content. There's a two-part question, Mark. One question is, CCH SureTax is comprised of the underlying content, and then there's the program, the SureTax as a tax engine. So the tax engine will hold several years data, so you can run old transactions. So let's say we have a client who perhaps wasn't compliant in the past and now is required, perhaps they're doing what's called a voluntary disclosure agreement, a VDA, with a tax authority. So they'll need to go in and do what the engine does. What the engine does is called tax rating. So tax rating means you'll run a transaction. You're, let's say, in San Jose, California, and you have a customer. It's because everything's driven off the customer. You'll run through the record as of a given date. This was the amount of the sale. The tax is determined by what's called a mapping of the service that was rendered to a tax code in the system. Mapping means to create a one-to-one relationship, and then we're running that through the system and coming up with taxes. That's called tax rating. So the old tax information that's stored in SureTax enables a customer to do tax rating for a prior period should there either be an audit that you're dealing with or a voluntary disclosure agreement. So keeping track of past rules can be extremely important for a client in dealing with compliance.
Right. Excellent. Yeah. I had no idea you went back so far. That's great to know. So in terms of what's currently happening in the telecom tax and regulatory space, are there any sort of recent developments that may be of interest to our MSPs who sell VoIP and UCaaS services?
So, when we say telecom tax regulatory space, there's various components in the actual legislation. The legislative wheels move slowly, but so that and one of the issues that we have and the difficulties we have in creating content, in the telecom space, is that so many of these statutes on the state level, local level are very outdated, very cryptic, and not at all keeping up with modern technology. That said, a number of states that was streamlined, etc., SST, have updated. So it's kind of a mixed bag. Some is updated, some is not. But there's a tremendous amount of analysis and review to just create a baseline in the content. Now, but once that content's established, the actual amount of legislation, I mean, Deena, if you're aware of anything that's happened, let's say in the past year, that's monumental in terms of legislation. My experience has been that, the legislation, it doesn't from one day to the next have much, it's pretty stable. But that said, what kind of changes in the ground that are happening is in the enforcement, that as tax jurisdictions are being pinched, needing more revenue, and the enforcement's becoming much more aggressive, especially in the space where the government, I think, sees that there's opportunity of creating revenue from non-compliant companies. So there's a much more attempt to, in terms of, for example, on the FCC level, Federal Communications Commission in the U.S., the enforcement agency is called USAC, the Universal, whatever it is, but the USAC administers the FUSF, Federal Universal Service Fund, and the other federal regulatory fees. They've doubled their amount of auditors. The states have become much more aggressive upon audit. USAC has become more aggressive in terms of their interpretation of the rules of the FCC. So there's an aggressive, but it's a mixed bag, to be honest, because you have the more aggressive and more tools also, right? All the automation, all the computers, all the technology enables an auditor to have more access to information. On the other hand, a lot of the auditors are quite inexperienced and don't really know what they're doing. So, it behooves someone who does get involved in an audit to make sure that they have experts, because they may be able to outsmart and outfox certainly the inexperienced auditor.
Right. It's good. So it seems more important than ever to get taxes right, isn't it? It's with the jurisdiction putting so much more resource into it. So at what point does an MSP cross the line? When they start selling voice services, when do they reach the point when they need to start filing telecom tax returns? At what level of revenue, for example?
Well, it's not so much. I don't think so much there's two confusions. One is the type of revenue is being generated and who the customer is, and then the threshold of the revenue is being generated. So as far as the type of revenue, jurisdictions define the word communications differently. The FCC has its own definition of what's considered a quote unquote communication service, and they differentiate that from what they call an information service. Something is either communications or information. If it's communications, it's subject to the FUSF, the Federal Universal Service Fund, at the current rate of 33%. Or its information service was non-assessable. That's the FCC. The states is a totally different story. The Department of Revenues, in theory, each of them can have their own definition of communication service, but generally they're not at all similar to the FCC in terms of their defining communication service. Streamlined is certainly puts a certain uniformity among a number of the states in terms of for sales tax purposes and how they define communications, but there's still many states not part of streamlined sales tax, and a lot of the larger states as well. And they each have their own definition. So when we say when do they cross the line to become a communications provider, depends what jurisdiction they're operating in and how the jurisdictions define communications. Now that said, a communication is going to be provided to as far as there's what the communication is, like is it fit in the box of how that particular jurisdiction defines telecommunications, and then there's to whom are they servicing? So if they're servicing the end user of the service, then the MSP will be subject to communications tax. If they're not selling to the end user, or rather to a reseller, it would fall under sales for resale, assuming that they have the correct documentation of a sales for resale. Now, a sales for resale is different for sales tax as opposed to Federal Universal Service Fund and other taxes. So there's so many different taxes in telecommunications. In a high tax jurisdiction like New York or Texas, in the city of New York, let's say, or Dallas or Houston, there could be a dozen different taxes applying to communication service, each having their own rules. So there may be one rule for one tax or fee or surcharge and a different for another one. So it's not necessarily all, but as you can see, it's very complicated, given that there's so many different taxes that apply. As far as threshold goes, there's no rule for that. I think before we get to threshold, we want to back up and say situs. Where is the service being located? So and how does that then create what's called nexus for the MSP? These are probably discussions in and of itself, would each be a extended session, but general rule in communications is that the customer creates the nexus, so that technically speaking, there's no threshold. In other words, if you have a customer there that in a particular state locality, there would be a requirement for registration. As far as what your tax professional would recommend in terms of what is reasonable, because this obviously create a tremendous burden of compliance to be filing tax returns of $1 in a single jurisdiction, or state. So if there's only one customer, it's a small amount. So that's kind of that's kind of like the unwritten rules of how do you manage compliance, and that's something you'd want to consult with your telecommunications professional. On the federal level, there is a de minimis threshold through the Federal Universal Service Fund of a $10,000 liability. So a company would, who's clearly crossed into communications would file with the FCC, but if they're not producing, they're not servicing a lot of providing a lot of communication service, they would, and they're falling under that 10,000, they would be de minimis. They would be something known as de minimis, and therefore not subject to be filing with the USAC and the FCC.
Right. Excellent. So, David, one of the questions we hear a lot is how are services like Microsoft Teams, Zoom, and other video conferencing systems treated by the telecom tax authorities?
That's a great question. So, in certain sense, these services are apps, right? So Teams is like an application. An application is not telecommunications, it's software as a service. However, it's providing a communications. When there's a voice component, especially, it was just a bridging / collaboration. It was just a web collaboration tool without any voice. So then you'd get into there'll be a question: is it just we could look at it strictly as an app? Once you're providing voice communication, then you're looking at something which is in a communication. Now, there was a case that the FCC finally educated with WebEx on original WebEx decision and a WebEx appeal, which is in the same family as the Teams and the Zoom. The WebEx decision rendered the service for federal purposes to be considered information service and not telecommunications. If your video conferencing service is similar to WebEx, which not in scope and is called to make a judgment on that, but certainly a legal advisor would be the person to make that call. But if indeed your video conferencing system falls into the WebEx category, then you would not be subject to FUSF. However, that doesn't mean you're not out of the woods in terms of being called communications by the state and local tax authorities. We have a separate, in our content, and which is part of CCH content, which is part of SureTax, we have a separate group for video conferencing. Our position is that it is subject to state and local tax. There's different, depending how it's sold. So whether it's sold as an integrated system together with the voice, whether it's sold in component parts, but again, it's generally the treatment is communications on a state and local level, but just bear in mind there's a hierarchy in the U.S. and telecommunications tax and regulatory surcharges, whereas the regulatory side, which is one part of the hierarchy, in this particular case was a great example of how this hierarchy, a dual hierarchy, works. The regulatory perspective on Teams and Zoom and WebEx is that it's not subject to federal USF, but the state and locals approach generally is that it would fall under their jurisdiction as a communication service. There have been these types of companies have had some severe beatings, and from what we've kind of heard through the keyhole, in terms of being beat up by tax authorities for not looking at their service as communications, and then being slapped, down the line with very high assessments, tax assessments, penalties, interest, etc. It can get quite costly. The cost of non-compliance can be fairly severe, and the best prudent advice is to try to nip in the bud and get ahead of it and deal with it up front. one consideration for the startup MSP is, if you may be aggressive now, but if you're not really looking at whether aspects of your service are telecommunications, once you do build up your revenue base, hopefully, and quickly, a lot of these companies then set themselves up for acquisition. Upon acquisition, there will be a due diligence by professionals who are very familiar with the rules, and if the startup acquisition candidate is deemed to be have failed to be fully compliant, there will be a reserve created. It may or likely to affect potentially the acquisition price, etc. So again, cost of non-compliance probably far exceeds the cost of compliance in a proactive way. We strongly advise companies or MSPs to look at their potential liability up front and deal with it while it's small and containable, as opposed to letting it just accumulate and become a bit of a monster down the line.
Absolutely. Well, thank you, David. That sounds excellent advice. And so David and Deena, thank you for being our guests today. To our audience, thank you for tuning into this episode of Talking VoIP with Datagate. Our guests today were David Rubenstein and Deena Levi of Wolters, Kluwer, CCH SureTax. So we wish you success in all your MSP communication endeavors, whatever they may be. And as always, may the VoIP be with you. Thank you.
Thank you.